All right, good morning, everyone. It is 9:04 in the morning of February 17th, 2022, and this is my pre-market strategy session. So the past couple of days on the market have been tough to trade. Let me pull down. Actually, we'll just take a look at the NASDAQ here. And I'll use the Qs. So the past couple of days, and I kind of expected this, after big sort of moves in volatility, here we have, let's see, the 10th of February and the 11th of February. There's a range there. This thing moved, let's see, 5.65% in those 2 days alone. After those kinds of moves, there's going to be a period where things just kind of settle down. So we're in that period of things kind of just settling out a bit. There's been, a lot of very volatile movements in the market here recently, and I think there is another leg lower coming. It is going to eventually happen. Right now, though, is just kind of a time to take it easy. So, when we start getting like in this period right in here, it was time to make hay right here. This is a 17.5% drop in what is that? A matter of, let's see, the end of December to the end of January, roughly. So in a month it dropped 17%. That's correction territory. I think that we are looking at a bear market developing. This is a bear flag right here. I'll just get rid of those levels. Not that important right now. We do have a bear flag developing right here, and the resolution is to the downside, and it makes sense for the economic environment that we are rolling into here. But these consolidation periods can take a lot more time than you'd expect to play out. And so, if we chart it, you can. I would expect. I mean, it's not. What am I trying to say here? Let's see. This apex right here to the triangle, or I don't know whatever, is the 10th of March, whatever you want to call this. So you'd expect some resolution for a direction for the market to choose, whether it's going to be up or down. I think it's going to be down by the 10th of March. You'd expect for that to occur. And that's, simple. That's a very simple charting, technical analysis view. But, it works. So, of course, it doesn't have to work. Are there any number of things that can happen? So for right now, this is what's going on, though. And so here, in moves like this one here, it's okay to size up. On the size of your trades, it's okay to go bigger. Here, though, it's a better idea to keep your size down. So that's what I'll be doing. Now, what we have, though, is a little bit of an opportunity with both the Russell or the IWM as well as the Qs, in that both of them are at the top ends of their risk ranges right now. So the NASDAQ is at the top end of its risk range. In terms of probability, it is more probable that there will be downward motion in price than upward motion. And the same thing with the Russell. So the Russell's right there at the top, real close to the top end of its range. And so the closer you are to the top end of the range, the higher the probability that a down, being bearish, looking for bearish setups, will have a higher probability than bullish setups. So essentially today, the NASDAQ and the Russell, I will be keeping an eye on both of those for bearish setups. In fact, actually, I'm going to put alarms. Let's put alarms on the Russell here on the 10-minute. I'll put an alarm on the 10-minute on the NASDAQ as well, although it's above the risk range right now. So the probability is that much greater. And then let's see, the SPY or the SPX. Let me go over to it here real quick. The risk ranges. You'll see the risk range on the SPX is kind of just dead in the middle. So, you know, if you are managing this becomes a money management. If you're in the middle of the risk range and you just want to pick a direction, bullish or bearish, as long as, you know, the statistics 50-50, right? As long as you have proper money management, to where you drop your losers at a specified percentage, and you let your winners run by a specified percentage, and it makes it, then you can still make money. It's just it's not probable. It's not as probable as when the risk range, you know, when the equity is close to the top end or the low end of the risk range. So right now the SPX could go up, it could go down. And these markets are starting to not trade quite as harmoniously. Like usually when the SPX is going up, they are, you know, and the Russell, the SPX, and the NASDAQ all tend to kind of move together. But recently here, we have seen that the different markets are starting to move differently with respect to each other. Just enough. You know, just differently enough. They still have rather harmonic tendencies. However, there is a more dramatic sell-off in the small caps. Then after that, tech, and then after that, the S&P. So you know, there's, if you were to consider those three markets like bonds, like bond yields. There is a steepening of the curve in returns on, you know, between the SP and SPX being at the higher side, tech or the Qs or NASDAQ, I should say, being in the middle, and then the Russell being at the bottom. And the spread is widening on those. So the spread is bound to tighten up. But what that usually means is that in a bear market, instead of the spread tightening by, you know, the Russell coming up or tech coming up to the S&P, what it usually means is the spread will come down by the SPX and the NASDAQ coming down to meet the Russell. So in percentage terms. So the things are, it's a developing bear market. And the probability, you know, is on the downside. So the setups, the trades that will occur that will be profitable will most likely, in probability, be to the downside. So I am still looking for downside setups, bear setups, and I'm just going to continue to concentrate here on, this is my daily list and this thing until, you know, something changes, which is not forecast to happen for quite some time. You know, it's the SPYs, the Qs, and actually now IWM, the Russell, Tesla, and Amazon. These things are just paying off. You know, I've traded them every day now for weeks. I don't remember how long it's been, but I'm consistently green day in, day out. I don't remember the last time I had a red day, actually, since I've been trading just Tesla, Amazon, and the SPYs and the Qs. And now I'm going to throw IWM in the mix today too. So if you know, you're out there, highly recommend you know, getting on board with the bear setups. Of course, there are going to be green days. There are going to be, you know, big green days, and so to turn around. In fact, actually, I traded Tesla to the upside yesterday. Here, right here. So I have this kind of this isn't the official risk range on Tesla. The official risk range on Tesla is from the bottom here at 859 to the top at 953. Yesterday, I was just paying attention to 900 even and 933 on the upside. whatever, I don't remember what it was that happened yesterday. Something about the Fed minutes that were released. I don't know the details of what it was, but price action just started going nuts. The level 2 just started going nuts right here. And when this thing broke, 907 right here, I started buying options on Tesla yesterday, call options on Tesla. And I managed to make a pretty decent amount of money right there into the end of the day. It was nice. So don't get married to any one particular direction. It just happens that right now the bearish setups will have a higher probability of profitability. So it tends to pay to stay on one side. But after you've been trading for long enough, you know when to recognize when bullishness comes into the market. So yeah, it was a contrarian trade to the trend, but it was worth, let's see, 906, and I got it at like just above 920, right in here. Right after it started to come back down again is when I got out of the trade. And so I managed to get $9 a share on, I didn't get $9 a share on the options. The options are priced a little bit differently, but I got the increase on the options, and I was trading 945s yesterday. I think that's the 945. I've forgotten why I picked 945 here. I don't remember why I picked 945s. But anyway, the strike was 945, and the expiration that I traded yesterday was the 25th, so a little bit more than a week out. And I got whatever the differential was on where I bought them down here at 907 to where I sold them at 922. I've forgotten right now. It was a few bucks per options contract, and so it was nice. So that's pretty much the strategy for today. Today is looking like, here we have the NASDAQ at the top end of the range for a couple days. If it opens below, comes up and tests, I'd love to see that happen. I'd love to see the NASDAQ open below here, come up, bang its head on the high end of the range right here, and then fail. And I will probably put on some rather heavy, my share size, my trade size will probably be rather significant, and I'll be looking for it to fail down below, or I'm sorry. So if this recent activity is any guide right here, these 4 days right in here, if that's any guide to what is going to occur the next few days, then let me get that out of the way. I'll be looking for a test of the most recent yesterday's low, on a red day, red day setup. So it's pretty much true with the IWM or the Russell too. I'll be looking for a test of a recent low right here, the previous day's low, or the day before that. Here. So today, right now, if the IWM opened up, it would open up at 204.52. A little bump up, a little bit of a buy, some possible short covering at the open, and then a retest after some bobbling around at the open, a retest of the 15th lows there. If we're going to be range bound, that would be perfectly normal market behavior. Perfectly normal behavior of the buyers and the sellers there. So, all right, everybody. Good luck out there. Keep your risk tight. Click like, share, subscribe, leave a comment, tap the bell, and I will see you at tomorrow morning's strategy session. I am out.